17. Yeah, let's talk a little bit about securities and what we mean by securities and their regulation and whatnot. Probably not something that you give a lot of thought to at this point in time and the regulation thereof and those types of things. But I would hope certainly as you get older that these types of things would become very, very important to you. They were in my prior life as a banker and have remained important to me. The individual laws, yeah, but what they allow and what they produce, I think, are even more important. And there's going to be some stuff in here that I may act like I'm skimming over because I don't find that it's all that valuable. But we've got our learning objectives, right? Want to know what securities means, right? So it's public offering and other types of offerings, right? The private or whatever. How the law covers those, yep. How private individuals certainly can make claims to enforce those laws. State regulations we're not going to talk a lot about. I don't believe Montana really has a whole lot of separate state regulations regarding securities. We'll talk a little bit about Sarbanes-Oxley. And we'll talk about Dodd-Frank or Franken-Dodd, at least for now. I don't know how much longer it may be around, actually, given our recent election. So, a moron. I wonder if that's somehow like a moron, maybe. So this is kind of old. I updated it a little bit. This is not that far off. We hit a big high in 2007. And then we had the financial collapse, right? And after that, equity markets were down, actually below this 17 trillion for quite a while. They've come back and they are above this. If I had to guess, they're probably in the $20 trillion range at this point in time. Bank deposits, their growth a little bit more static. So we're seeing more and more people. Really, you could say invest directly and invest in the actual market. So. Stuff you can see about our financial markets versus financial markets in the world. Supposedly, or at least when I Googled it, I said, where's the world's first stock exchange? This was the photo that came up. I have no idea if that's right or not, but oh well. The securities regulation began, we had the Great Depression. And if you guys remember your history, remember that October 29th, right, of 1929. Is it the 29th? Yeah, was when they had the big collapse in the stock market, and I go into the history of what caused that and whatnot. But the laws were pretty lax in regards to security regulation. People were allowed to do some things that created bubbles, not unlike the real estate bubble that we had. And a lot of the rules actually that weren't in place were the same. They allowed people to borrow too much money, basically, to make purchases that probably weren't that prudent. And so we created some new rules. We started to regulate the purchase and sale of securities. Mainly, and as we go through this, and this is huge, you need to know this, that mainly what's important here is that it's provided for the dissemination of information. So you and I can get information that before we couldn't, right? There are, of course, federal and state laws. And then we had the Sarbanes-Oxley in 2002. Doesn't seem right. It seems like it was later than that. But so the Securities Act 33-34, heart of the Depression, right? Insider trading, we had in 88. Securities enforcement, Sarbanes-Oxley 2002, and Franken-Dodd in 2010. So what is a security, right? When somebody invests, right, and others manage it for profit. So you buy a security and you're not necessarily actively involved in the management. It's not to say you can't be in the management. You can certainly work at Wells Fargo Bank and be a manager and own stock, right? But generally speaking, we're purchasing securities and other people are managing it. Know the Howey test. It'll be on the test. That it's a three-pronged test, and that's how the question will be. It's a three-pronged test to determine if something is an equity. Is it a common business activity? Generally speaking, retail, manufacturer, whatever the case may be, any numbers of things, right? Are the profits earned through the efforts of somebody else? And is there a reasonable expectation of profit? Certainly, it doesn't mean that it's going to be profitable, but just that there's an expectation thereof. I don't worry too much about the dates, but the SEC, right, Securities and Exchange Commission, was set up in 35, and it's an administrative agency, right? And we've studied administrative agencies, and so it has, the same duties and the same responsibilities that other agencies have in terms of legislative and judicial functions. And it regulates our stock exchanges. And there's the two major stock exchanges. Those will probably be on the test too. May not be anywhere in here, but the New York Stock Exchange, or NYSE, and the NASDAQ, NASDAQ, which stands for the National Association of Securities Dealers Automated Quotients. How's that? So they're the two major stock exchanges that get regulated, but there are other exchanges too, and there's besides stock exchanges, there's Chicago Board of Trade, Chicago Mercantile Exchange, and different other ones. So they regulate utility holding companies, investment trusts, and we talked about trusts, when we talked about antitrust, right? And that's what investment trust kind of set up. And then investment advisors, your local D.A. Davidson or Waddell & Reed, or those guys, they're all subject to regulations from the SEC. Before that, there was the Securities Act of 33, and this is the disclosure law and about going public. And this is one of those things that there's a decent amount of in this chapter, and I don't think I ask a lot of questions about it because it gets a little bit confusing, right? And there are important things about this that you kind of need to know, right? But I don't know that you want to go overboard. So there can be criminal punishment, civil, right, or injunctions can happen in the process. They might prevent somebody from going public if they think, things are amiss. So parties that have to comply are issuers of the stock, the underwriters, which are usually investment banks that get involved in that, controlling persons, the ones who control the stock going into the fact that it's becoming public, and then the sellers of the stock, which can be the underwriters and many others too. I'm trying to think how much of this is really important. When a stock goes public, and we've had some high-profile stocks go public, probably within the last several years. Facebook's not that old of a company. Went public not all that long ago. Twitter is not that old of a company. Tesla is not that old. I'm trying to think of some that are even more recent that have just gone public in the last little bit. Uber, on the other hand, and Uber's a huge company. They value it at probably $50 billion, is not public. As we speak, Uber is still a privately owned company. So it's kind of interesting, that it can be a big company and yet still be privately owned, right? So to go public, these things are required, right? You have to disclose your financial information, and you have to go back. Presumably, you've got a history that goes back a few years. Okay. Then there's a pre-filing period, and that's, of course, when you would do these disclosures. And there's a waiting period, and there'd probably be a question about a tombstone ad, just because, and that's an ad that runs during the waiting period, and that used to always run in the Wall Street Journal. I think it still does. Okay, and in that ad, and it used to be shaped like a tombstone. That's why they call it that. It's just a notification, basically, of a company that's going to go public. And then there's the post-effective period, and I think that's the period from the time that stuff happens until the company actually goes public, which is a date to be determined later. Okay, this prospectus, or those final financials that you or I or anybody can get if we're an interested investor, right? Okay. Those have to have detailed facts, have to have detailed financials, on and on and on, and accurate. Not just detailed, but they have to be accurate. And like with many things, there could be criminal or civil penalties if there's willful, if there's fraudulent disclosures of facts, et cetera, et cetera. Okay, and Fraud, of course, is an untrue statement of material facts. You might omit some material facts. Could be all of those things, right? Or omit information resulting in misleading potential investors, and certainly it could be a number of things that would happen, that would be considered fraud. You know, trying to think of good examples of what fraudulent stuff might be. I mean, purely misrepresenting your numbers, your growth in revenue or your revenue numbers, or those things would clearly be fraudulent, right? Doesn't always have to be financial too. This could be stuff that deals with controlling people. The health of the CEO or things like that could be important, right? Those could be material facts. Ongoing lawsuits can be important. There's hardly a company that's a big company that just doesn't have a lawsuits going on at just about any given time, right? And those need to be disclosed, right? And failure to disclose those might be an omission of material facts. Okay. Now, if somebody's suing the company in small claims court because the product that they got didn't work all right, and it, you might have to give them back their $300 or whatever, that would not be considered material, for companies that are that size. But a class action lawsuit that's involving thousands of people would be, right? So fraudulent transactions, certainly nothing in there that's terribly important. Materiality is just the definition of that is prudent, something that a prudent investor would use. That kind of goes back to my description. $300 lawsuit in small claims court is completely different than a $3 million class action lawsuit, right? Statute of limitations, and this deals with people. If you're one of the initial purchasers of this stock, right, and you discover maybe that there's some fraudulent stuff, you have 1 year then to file a lawsuit or to make a claim, basically, and no more than 3 years from going back to when the final prospectus maybe was issued, right? So 1 year after you discovered it, you'd better make your claim, but no more than 3 years after that. Okay. Due diligence says that you, as an investor, have an obligation to reasonably review those financials for companies that are going public. Initial public offerings, don't forget IPO, and I don't know if we have IPO in here, but that's what we're talking about when we're talking about these, or IPOs, or initial public offerings. Okay. That's a primary market. Okay, what you and I are probably more familiar with is, the secondary sale of stocks. Companies that have been public forever, for even a year, whatever the case may be, and you and I can still go in and buy and sell interest in those companies, right? Be it GE, one of the older ones around, or be it Facebook, that's a relatively new company, right? And so there's what we just talked about were regulations that had to do with those companies that are coming to the public markets brand new. Okay, what we'll start talking about now is the transfer of securities after that initial sale. So being public means this. It means that you have to file forms with the stock exchange. So depending on where your company's listed, be it the New York Stock Exchange or the NASDAQ, the two major ones, you have to file forms with that exchange, and then you also have to file forms with the SEC, and it's periodic reports. And ones that are mandated are like quarterly financial statements. Okay, they have to be sent to the SEC, and there are other ones too. Insiders, they have to file or the company has to file whenever insiders start transacting shares and whatnot. That has to be filed. Notice has to be given to the SEC about those types of things as well. Okay, and these are the types of folks that can be affected by that. Sure. There is, I presume, the NASDAQ. At least it's a nice picture of something that says NASDAQ on it, big letters. And that is the New York Stock Exchange. Kind of an interesting old building. So SEC enforcement, right? Again, we have that materiality rule. person's liable can be insiders, and we've had some insider trading deals, and there's still some that are kind of ongoing, that happen. There was in the last 3 or 4 or 5 years, there's been an aggressive position against insider trading, and for a while, I think it happens in New York more than any place where the New York Stock Exchange is. But their attorney general was really, really successful in getting some settlements and/or convictions. The last several, not so successful. So, but insiders, right? Broker dealers have to deal with that. What they tell the potential investors. Right? They've got rules about what they can tell potential investors. They can't lie to you, about a stock, try to get you to buy it. That would certainly enhance their bottom line maybe, but it might not be good for you, right? Corporations obviously can't be saying things that are inappropriate. Those who aid, abet, conspire, sure. Okay. 10b again, the plaintiff must prove there has to be some losses. Okay, excess of paid and received, and it's measured at the time of the purchase. I don't think there's anything on there that probably materiality, again, insiders. It says an insider can be anybody that owns more than 10% or a director or officer, and insiders have to file within 10 days. So again, that's that other filing. I think it's an 8K or something like that that goes to the SEC when those folks buy or sell a stock within that company, right? Insider trading affects far more than this, because it affects people that maybe on the outside that know people on the inside, right? And so if I called my old buddy who's the outgoing now, he's the outgoing CEO of Glacier Bank, and I said, Mick, how's it going? Tell me about it. La da 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 da. If he gave me some inside information, if he gave me general information that, hey, the bank's doing well, geez, we're expanding, life is good, that's one thing. But if he gave me information that would lead me to short swing profits, like, ooh, we're going to report a bad quarter, and that's coming out on Thursday, you might want to get out of the stock on Wednesday. Something like that would be a short swing profit or avoidance of a loss, either one, right? And so those things happen, and they can be illegal. You can't profit from information that's not available to the general public. Okay, we're right there. Okay. And there can be civil and criminal liability. Good old Martha Stewart, and hers was that case. She was friends with a guy that who was the head of a company. The name of the company, it was a drug company. The drug I can remember was Erbitux. Can't remember the name of the company, but she knew the guy Sam Waxel. I can remember the guy too, Sam Waxel, and he was the CEO. And he said exactly what he'd called her or got information to her through other people, through other channels, that they were going to report a bad, or actually one of the drugs that they had produced was going to get a bad rating. That's that Erbitux. It was going to get bad review by the FDA, and so she sold. Okay, it amounted to, she avoided about a $200,000 loss, which in her case was nothing. Okay, but in any event, she avoided that loss. She got caught. She never did get sent to jail for insider trading. She actually got sent to jail for obstructing justice because she wouldn't release the stuff, the emails and those types of things that likely would have led to her conviction for insider trading. Enron was an interesting case. Enron, we kind of forget about a little bit. You guys do, because it was before your time, but what happened there was a pretty horrible fiasco. Ended up costing a lot of people a lot of money, and Sarbanes-Oxley was actually a result primarily of Enron, and then I could go into great detail, not great detail, but I could go into some detail about the scheme that they were doing, but one of the things that they were certainly doing was going in front of the public and saying how wonderful their stock was doing and how wonderful the company was doing, and so the stock price kept going up And what they were doing in the background was the executives that were saying that were actually selling out their stock positions as the stock kept going up. And then it eventually collapsed because it turns out that they were being fraudulent. So in 95 we had the Reform Act, which dealt with private securities. So private securities, the old bank that I used to work at, and they've here in town, Independence Bank, it's privately held, okay, but there's a number of shareholders around town, okay, and by number I mean a couple hundred. So it's not, it's not just exactly family owned, but it's privately held. It's a small number of shareholders, and they're not listed on the NASDAQ or the New York Stock Exchange, but stock can be bought or sold there, right? Only the SEC can sue third parties not directly responsible for securities violations. It's kind of interesting. So outside of the loop, I guess. Private plaintiff must allege slender, I hope I'm pronouncing that right, of company executives and private damages limited. And this gets back to insider trading when it comes to some of those small companies. Okay. State blue sky laws, again, in the MCA, which is Montana Code Annotated, Title 30, Chapter 8. There is some information about that, but I've read through that, and I don't find, again, that Montana has a tremendous amount of laws that govern security transactions, private security transactions within the state. The public security transactions are governed by the federal law, and I don't think Montana has really any of those, right? Okay. So Sarbanes-Oxley again, and I think this was part of your guys' assignment, but increased the SEC's authority and gave it some more money, gave it a little more investigative and enforcement staff, created the Public Accounting Oversight Board, is that what it was? Increased authority over governance issues, so over some of the board issues and whatnot. Public Company Accounting Oversight Board, yeah. Separation of auditing, consulting, and accounting firms. And this was kind of interesting. It made a lot more work for accounting firms, which is okay, I guess. But what this means is basically we call it auditing and consulting. So consulting firms are generally those that prepare the taxes and help the company on a regular basis. An accounting firm that would do that. Auditing then are folks that would come in and check the company's books and make sure things are going as expected. And in the past, it was very commonplace to have the same company do it. You just never thought two things about it. Well, it turns out that in Enron's case, that the accounting firm, which was Andersen at the time, Andersen, I believe, they were kind of complicit. They were kind of violating the rules too, right along with Enron. And so one of the things that they did was separate. So there's a separate firm that comes in and actually audits the other firm's work. So auditors are more independent, and that just makes sense. If it's not the normal firm that's really consulting that company, the audit firm just kind of comes in on their own and does it, right? Maintain trust of public and corporate shareholders, sure. At least one member of the audit committee, so these corporations are required to have an audit committee, right? They have to be a financial expert, and what that entails, I don't know, it has to be an accountant. It could be somebody like me, even, I suppose, would be considered an expert because you've had some experience and have a master's, whatever the case may be. Auditor reports to the audit committee, and they have to preserve their record, sure. So they say that some of these are the most controversial. To me, these weren't controversial at all. But the CEO and the CFO have to certify the accuracy, so they have to sign the quarterly and annual financial statements. What happened in the Enron thing, just briefly, was that when the House of Cards came tumbling in and they went after the CEO and claimed that he knew, he had never signed any of the quarterly or annual financial statements, and so he pled ignorance. He said, this was all, the underlings that were doing that, and I didn't have anything, I didn't have any knowledge, da-da-da-da-da. And so now they can't say that, right? Company goes under like Enron did, the CEO will have signed the financial statements and will have no right to be able to say that they didn't know. Okay, because they're signing the statements, verifying that they do know and understand them, et cetera, et cetera. So that to me was a big change, and I didn't find it to be controversial at all. By the way, Kenneth Lay was found guilty of committing those frauds and whatnot, and fortunately for us, he passed away, had a nice heart attack before he went to prison, where we'd have had to pay for him to be in prison for quite some time for the pain that he had perpetrated on a lot of people. And executives must return bonuses paid as a result of incorrect financials or some clawback stuff. So, old Bernie Ebbers, that's a long story. It's an interesting and a sad story, actually. There's some fraud stuff, and he ended up spending some time in prison, but he was a little bit more innocent, a little bit more. Okay, so there's more punishment for the fraud, conspiring, and they did put in place some whistleblower protections. There had been some whistleblowers in the Enron thing, and they were kind of ignored. So IPOs, right? So we had quite a few, and this is again a little bit dated. If you remember, this was the height of the real estate boom and whatnot, and the stock market boom that we had in 2007. Then the Great Recession hit, right? And look at that, 2009. Of course, March of 2009, stock market hit a bottom, and IPOs likewise bottomed out. Companies don't want to go public when there's not a lot of interest in the stock market. Okay, they want to raise as much money as they can with issuing as few stocks as they can. Okay, and the financials of that, I guess, in a finance class might be a little easier to explain, and we will. But that's just the basics there. That raise as much money as you can by issuing as few shares as you possibly can is basically it. And so when the stock market's in a hole, like it was in 2009, okay, that's what happens. And I don't know, I used to have some updates on that, I think. So there you go. Looks like he's conducting a little research too as we speak. So there you have a little bit of securities regulation, chapter 17.